Hello, everyone. Welcome to today's session. Let's get underway here, and we'll start out with market conditions as we usually do, talking about our top-down approach where we're focused on what is the current state of the market as a whole, really looking at the big picture where we have been and where we are currently in the trend. And then from there, drilling down on shorter term trends and focusing on what the overall trend looks like. Are we at the upper end of the trend and reversing? Are we early in a trend? Are we in the middle of the trend? And then talk a little bit about allocation ideas and some of the risks that are associated in the market currently as well. Long-term perspective here, starting out with the market trend tab. If we start out with this perspective, that gives us essentially all of our larger economic and price activity barometers of market conditions. Starting out with market trend and the direction alerts, we have the momentum indicator here. This is the 1-year momentum trend of the S&P 500. This bottom chart is the chart of the 20-year time frame for S&P 500. So essentially this momentum line is just covering really from about here on. It's not even covering this entire low now, but this upper end of this range. So we know that we're at the top end of the trend on S&P 500. We know that we have been in a really nice bull market for 20 years and really for a long, long time, with a few stops and starts along the way. We had COVID here. We had some retracement of some of the economic stimulus that had taken place, that oversupply of monetary stimulus with COVID, and then dealing with inflation, and now we've been continuing to rally here. A lot of this has been due to technology and AI and productivity as well. So we're continuing to move higher. The momentum, though, the probabilities of more upside when we're already at the top end of a trend start to diminish. And so one of the ways to manage that, if we're buying individual stocks, is by position size and the number of holdings that we are utilizing for our equity position. So oftentimes if you're doing, asset allocation models, a really common one is, 60-40, meaning 60% into stocks, 40% into something else like bonds or cash. And as risk increases, or as your need for less volatility starts to increase, then you want to adjust these numbers as well into smaller and smaller percentages. Now, we've been in about 25% equities for most of this year, and we've been in about 70 to 75% in cash for most of this year. So it's been a relatively flat year. We've had some ups and some downs along the way, but part of it is due to this reason right here, and that is because of this reason right here. We want to participate in the upside, but at what point is the market going to reverse and head lower? Okay, and there's another factor to that. That's the bond yield curve. I'll touch on that. We talk about it every single week because I want to continue to bring that up. But some of the other shorter term signals that we focus on, there are really three pieces to this puzzle. And that is, we want to look at sentiment, we want to look at breadth, and we want to look at momentum. Momentum is what is happening to our price activity. Is price activity moving higher or lower? Is it moving before any of these others? Is it moving after some of these others? Breadth is the amount of participation in the uptrend. What percentage of stocks are involved in this uptrend? Is it a larger percentage? Is it a smaller percentage? Because that can tell us the quality of the rally. Do we have a lot of stocks in the uptrend? That's going to tell us that the quality of the rally is really good. As that starts to decline, and there's only a small number of stocks that are pushing the market higher, then we have to be a little bit more concerned about the quality of the rally. So momentum currently is, in this chart of all three, the orange line is momentum, and this top chart is S&P 500. So we're moving towards the upper end of this range. We've broken out. Now we're working on a little bit of a retracement. It feels a lot worse than it looks for whatever reason in some of this market volatility, but we are approaching the upper end of the range. But we're not at an extreme range. We've been a whole lot more extreme in some of these other rallies and tops in this overall uptrend of the last year. And so that means that we could certainly, we're at an area where we could get a retracement. We can always get a market top at any time. Obviously, the market will let us know we're going to start shifting back this direction, and we're in that range now. We're getting very close to starting to curl back into that range bound and not momentum driven, either to the upside or to the downside type price activity. Breadth has been moving nicely, 75% right here. So we're at the upper end of that range versus the lower end of that range. And it's been really volatile as this last half of this year has been, we've had a lot of ups and downs, a lot of whipsaw. Okay. I had a question today regarding performance, and whipsaw when we're dealing with momentum is always a struggle because we get stopped out of trades in a retracement, and the whipsaw is all of a sudden we move back up, and now we're back into momentum. So we accumulate again, and then we get stopped out of some of those trades. So that's whipsaw, where you get a move higher that gives you momentum. It reverses, you get stopped out. You get another move back into momentum. It reverses, you get stopped out. So these kind of price activity patterns in the market are hard on momentum trading portfolios. Okay, so that's another part of the reason why we have a smaller allocation, because we're at the upper end of the range. We know we're at the upper end of the range, and market tops and bottoms are harder on momentum trades because of those reasons. We get whipsaw, and we get more volatility than in other trending market environments, and that is currently the case right now as well. So breadth's still strong. The other really a little bit more concerning indicator is this one right here. Now this sentiment indicator is linked to the VIX, which is the volatility indicator, which is linked to the extrinsic value of S&P 500 put options. So basically what it's measuring is fear and greed in the market based on the option market. And big institutions will buy put options when they are hedging against a downturn. And when put options are being purchased, that means the extrinsic value is spiking, and that's what the VIX is. It's a spike. And this is the inverse of a version of the inverse of that. So as that starts to move lower, okay, let me jump over to this. I'll show you just another perspective. Indexes and then this VIX ETF right here. Okay, this is a little bit more of an indication here when you get these real big spikes, and here when we start to see this, that means volatility is starting to increase. That means fear in the market is starting to increase right here. This is what it looks like when it's full-blown panic. Okay, and in this case, this was a really rare scenario where we had a massive spike in VIX, and then it immediately came right back again. Okay, that is volatility at its finest right here. But we're starting to see higher lows on volatility, and that's what we're also seeing is essentially the inverse of that on this indicator. Here we're seeing that this line is starting to get some divergence. Markets are going higher, and we're seeing divergence. That this indicator sentiment is coming lower. That means you have institutions that are selling into these rallies, and that's an area of concern that we want to be aware of. It doesn't necessarily mean the markets can't go higher. It just means that there's profit taking, there's portfolio adjustments starting to happen at these levels, and that's becoming more and more obvious, as particularly if you just look at this chart and say, how much higher can we go from here based on some of these trends. When they move up, when they move up, when they move up, when they move up, they typically come back to a sustainable trend level. Reversion to the mean, as it's often called, but it's a sustainable level. And markets are just an auction, and auctioneers, which are us, we're buying and selling based on greed and fear and anticipation and the unknown. And when the known starts to present itself, we're like, damn, that's uglier than I thought. Let's, now we have information we can make new decisions on. That's what the market is always doing, is basing information on what is known or what is anticipated. And then once that anticipated information becomes known, and it's different than the market anticipated, you either get buying or selling. Okay, so right now we start to get these parabolic moves. Now, if you were to think of a market chart like this, that's a sustainable uptrend. Okay, this is a 20 years of S&P 500. That 45-degree angle on a stock chart is typically pretty sustainable. But what happens is markets and stocks do this: they go up, they come back down. They may find this level, and then they may go higher, or they may overshoot back to the other side, and then you get this, then you get an overshoot, and then you get a rally back up. But ultimately, they're heading in this direction, but just with a lot of craziness along the way, a lot of ups and downs and volatility. And so we have to, our goal is to understand that we have opportunity in stocks to outperform other asset classes, to outperform cash, to outperform bonds, to outperform real estate, But we also realize that we have risk. Liquidity in the stock market is instantaneous. In the real estate market, it's not instantaneous. You can't sell your house in 2 seconds, okay? Like you can sell $1 million worth of a stock in 2 seconds. You just can't do that. So price discovery is instantaneous in the stock market, and that adds volatility like this, and it stresses us out a whole lot more. We can't look at our brokerage account. We can't log in and see the real-time adjustments of our value of our houses. If we could, we would probably be a lot more concerned about that. But because we can't, and because the liquidity is not always there, it moves a whole lot slower. And so our perspective of these asset classes to change a little bit. But we have opportunity to grow our wealth in utilizing stock. Now, our methodology primarily is focused on stocks going up, or buying companies, buying good quality companies that are going in an uptrend. Here's a good example. This is Limbach Holdings. Okay, this is a building construction stock. And over the last couple of years, it's been in this real nice uptrend with a few pullbacks along the way. At some point, that's going to end. At some point, this uptrend is going to reverse and come back down again. But in the meantime, we want to just continually try and focus on these. When this stock falls out of favor, we'll replace it with a new one that is in an uptrend. And overall focusing on what's working, continuing to go higher and higher, because that's what companies are designed to do. Okay, in stock trading, there's a lot of different ways to do it. You can buy it and sell it in a short amount of time frame. You can buy it, you can short it, you can use options, there's all these different ways to participate in the stock and options market. But for the most part, what we're focusing on are, what is this company doing, and is it growing higher? And as long as it's going higher, we want to participate in that. So in this case, if we were to, just off this 2-year time frame, if we would have just bought and sold anytime we had a new green after a red, okay, a new green after a red, and sold at the red, then we would have had a certain performance along the way as it's going higher. In this case, that's not giving me the full perspective here. Oh, there we go. Okay. So in this case, 353%, 40% on average winners, 6% on losers, and a pretty decent win percentage along the way. Okay, that's a lot of the other perspective is, if you're buying a stock, why are you buying it? And why, and when are you going to sell it, and why? Okay, and that becomes the trading plan or the ownership plan of why you're buying stocks, and then when you're going to sell it and how much you're going to and why. Having a strategy and a plan to be able to do that. This just gives a little bit more structure to that plan. Now, a lot of times we will also do a methodology that will stop us out a little bit early. Oftentimes it ends up being pretty close. For example, if I were to pull back here, we talk about this 236 level. Okay, this 236 level, because it's easy to look at a chart historically and say, yeah, I can see that, I can do that. It's a lot harder when we're in the moment and we're saying, and this is our moment right here, and we're saying, what should I do right here? We're in an uptrend, it's retracing. I want to also have an area that when I know that when that structure of that trend starts to be at risk, then I need to have a line in the sand that says I'm going to exit out of this stock because I've now put more capital at risk, okay, or I'm risking more capital. What happens to a lot of traders and investors is they don't have an exit strategy, and so when a stock continues to drop and it's like, crap, well, it's Limbach Holding, they'll recover, they'll be fine, we'll be fine, we'll just hold on to this for a while and see what happens, okay, and that becomes the trading plan is we'll just wait it out and see. And some stocks never recover. Some stocks take forever to recover. So in this case, we'll typically use the structure of, I want to have an area where I'm going to get out no matter what. Okay, and it may be this, oftentimes it is the 236. And the reason why is most of the time, if it breaks that or very close to it, you're getting pretty close to a new shift in trend anyway. And we want to be out of that trade. Now, let's say that we did buy it and we sold either on this sell signal or we sold on a stop out based on the 236. Okay, now the question is, I love this stock. I like the idea. I want to get back into it. When should I buy back into this stock? Well, now we can wait for the volatility and the trend to reveal itself again. We're still not interested. We're still not interested. Now in this case, there's confirmation. Okay, and some people would argue to say, well, why didn't you buy here? You could have bought right here. Well, yes, but would you have bought right there at this level? Okay, if I'm back here and you're saying it's in a downtrend, could it continue to go higher? Yes, it's in a solid uptrend. Yes, we have reason why we could buy here. And that's just a different strategy. If I am buying into pullbacks and buying into retracement, that's still a valid strategy to utilize it. But if we're just flat out following momentum entries, then we want to follow a different strategy and a fixed process. And the next step to that is to say, okay, where is my next location? I know I'm in an uptrend. I know I've retraced past the momentum zone. When we get lower than the momentum zone, the structure of the trend starts to break down. And that's where additional sellers can come in. That's where something is happening that we're just not entirely sure if this is going to continue an uptrend or if it's going to continue a downtrend. We don't know the future. I mean, we obviously do on this chart because we're looking back and we know what's happened. But in the moment, you don't know that this is going to go higher or not. And so you've got to be able to say, well, when would I get back in? And then from there, what is my strategy? So if I add another day or two and go back to this buy signal, there's our buy signal. So now we're saying confirmation bar, increasing volume. And if you've watched any of these other videos that I've done over the years, then you know that this is what we're looking for. Okay, this is the confirmation move. We have two things that are happening here. One, we have additional proof. Okay, we have additional evidence that there is demand. Okay, bigger buyers are coming in. Why? Because the volume number is increasing. Volume number is just how many shares are being transacted that day. A lot more shares on an increasing price is telling me that somebody is buying this stock. Now, what I want to do from here is piggyback on that idea and say, oh, okay, I'm not, maybe I am smart enough to figure this out, but there's a whole lot of other smart people out there that are buying millions and millions of dollars of this stock. I want to be on board with those guys, okay? And I've got to allow for a little confirmation for that trend to turn. It's called trend following or momentum trading, and that's what TradersPro primarily is. We're focused on the green trends. Okay, when they turn into trends, these are just the trend, the momentum of the time. And the momentum can shift, and it always does shift. We just have to be alerted. We have to be paying attention to that, and then we have to set up the risk profile. Okay, so in this case, I would say, at the end of the day, this is also an end-of-day system. So I'm saying I don't want to buy it during the day. I certainly could if I'm watching this stock and it's approaching the end of the day and I said, oh, I want to buy it right here. But most of the time, it's the end of the day. We're going to focus on what's going to happen the next morning. Sometimes that works for us. Sometimes that works against us when we're dealing with a gap higher or a gap lower. But in this case, we're focused on our risk profile. So in this case, if I bought it at the market open the next day, let's say that it's $35.44, and I've got to set my risk profile saying at what point, if this stock reverses and goes back to a hold and then goes back to a downtrend, at what point am I going to get out of that stock and preserve the capital that I've put into it? If I've put $2,000 into this stock, then at what point am I going to say, ouch, that's hurting now. I don't know what's happening, but the structure of this trend is now breaking down. I've got to get out of it. And with stock trading, we have the ability to do that really easily, utilizing stop losses and trailing stops and brokerage functionalities that make it super easy. Okay, and then from here, I can say, I want to buy into this and I want to set a stop loss down to this level. And from here, I could say, what percentage of my portfolio do I want to have in this stock? Let's say I have 100 shares. Okay, this is showing the current price. So let's enter in $35.44. Okay, and I could say, and if I had a stop down here, if I decided I want to give it plenty of volatility, but I'm okay with realizing that if it dropped down here, I might get stopped out. Let's go a little bit deeper, and I know that if it closed down in this zone, I probably need to be out of that trend. I've lost the uptrend. Okay, it's now either not trending or at risk of becoming a downtrend, and I don't want to participate at that point. So I've got to set a stop loss number. That's this number. So number one, I know that if I bought 100 shares, I'm at 3% of my portfolio. Portfolio size is this. and I want to be able to put a certain amount. This number is risk profile number one. Is that too high? Is that too low? You've got to decide based on your own trading plan. We'll typically go with 2.5%, so 3% is close. But if I went down just a little bit, say 80 shares, there's 2.5%. Right now, we're doing closer to 2% or even 1.5%, just because market conditions are so extreme to the upside, and we want to take a little bit less risk. The trade-off is less performance, less return, but still in anticipation of outperforming cash or outperforming bonds. So we can't get it all. We can't get the best of both worlds. We can't take no risk and get huge returns. Okay, you have to take a lot of risk to get a big return. So in this case, we have to balance the risk and the reward with potential probabilities on a trade. So in this case, I would say let's call it $28. $28 is my stop. If I did 28 and I bought it right here, that puts me at 0.45. Okay, that's a pretty deep stop loss, 20% from here all the way back down to here. That may be too high. This number is too high because I want to try and keep that at 0.3 or lower. And again, these are general rules. You can adjust them and should adjust them to your own risk tolerance. If you want to take more risk, you just have to buy more shares or have a tighter stop loss so that you can buy more shares. So if I wanted to buy 100 shares, let's look at the stop first. So I need to adjust my stop loss if I want to keep my number of shares where they are and move this number to a 0.3. So if I'm at let's say 30.51. 30.51 is the 236 Fibonacci retracement, which is basically the swing high point and the swing low point. It's retracing back a certain percentage. In this case, it's 23.6% of that move. And that tends to be a pretty good location to maintain momentum. If it drops below that, we're starting to lose momentum. And then it becomes a correction, becomes a counter trend. It's still in an uptrend, but it might take months now for this to correct itself and then get back into momentum. Okay, so I want to utilize that 236. So let's say if I adjust my stop here to 30.51, 30.51 is 0.30. So within my trading plan, this would be within the parameters that I'd be comfortable with. And I could go ahead and buy 70 shares of this stock with a stop price of $30.51. Okay. Now, notice there's no target. For the most part, we're not using targets, although in the trading plans, we talk about selling, how to exit positions. And part of that is selling into strength, but not selling all of it into strength. And there's various ways to do that as well. One of the ways to do that is at 25% gain. If you have a 20% gain, we sell 25% of the holdings. So if I had 100 shares, I'm going to sell 25 shares into the strength as I'm hitting those gain numbers. And you can change those too. Even 10%. If you're up 10%, sell 25%. So you're selling into strength, but now you still have shares for this possibility of a lot more upside. And we have some of those that really take off, and we continue to hold on to a certain number of shares, sell into strength, adjust the stop loss, and manage the portfolio that way. And then we can do that with 20 or 30 stocks at a time, and not have it be too overwhelming in terms of managing those portfolios. So this would be the setup here. Now, if we were to continue on with our example, and we just adjust this going higher. Okay, now we had a big move higher, still moving higher, still moving higher. Where's our initial stop loss? Our initial stop loss was I already forgot what it was. 20. Down in this range right here. Okay, now look where the 236 level is because the price is moving it higher. I could trail my stop loss higher at some point. Ideally, you want to wait for retracement and then confirmation and then start to adjust the stop loss because now the stock is proving that it's in an uptrend. We still have to allow for some volatility, and we want to be able to let it be volatile. So here's our uptrend retracement. Okay, now at this point we could say we have a sell signal that hasn't moved back yet. We could adjust and say I'm going to sell some of the position here, or I'm going to sell all of the position here, again depending on the overall strategy, and this would be out of the trade now as it's retracing, continuing to move higher. Here's our new move back into momentum. It continues higher. there's a gap lower, another possibility for a stop out right there. Okay. This is just all with the same stock. Now we're no longer in momentum. Now we've moved back into momentum. So now maybe I'm back into the stock and I've decided to repurchase, or I'm adding into a certain number of shares that I'm owning. Okay, so that process, at some point, it's going to reverse, and it's never going to give us a new option. It's just going to be, downtrending, downtrending, downtrending. By then, it loses its rank because it's underperforming the rest of the market. And then it's like, oh, this thing's now a dog, and I don't want it anymore. But while it's in this momentum moving to the upside, I want to be able to participate in that. That's really the logic behind what we're focused on and why we're focused on it. Instead of saying, "Oh, I've got a new sell signal. I'm going to short this thing and see if I can make money to the downside." No, I'm going to buy it. Now I'm going to buy it to the upside. Just be patient and just wait for new opportunities to the upside. Okay, unless you really understand shorter term trading, and this methodology is probably not the best one for you for that reason. Focus on a little bit longer term. On average, this spits out about 4 trades a year. Okay, so one stock, 4 trades a year. Times that by 20 stocks, you're getting a little bit more activity, a lot more activity if you're doing a wheel methodology where you're buying into a new buy signal each day and you're managing those each day. We get quite a few of those buy signals along the way. Now, places to start to look for those trends. So you're starting here, market trend. You're looking at your buy-sell ratio. Buy-sell ratio is getting a little bit weak. Overall perspective, we're at the upper end of the trend. Now, bond yield curve, we're still dealing with this bond yield curve. We've talked about this before, where we get inverted yield curves, and stocks typically will retract. The economy retracts, and the interest rates have to drop. Okay, so now we're seeing a scenario where even the bond market now doesn't like what's going on again. And let me jump over to here. We're seeing a pullback in longer-term bonds back down again. So interest rates are starting to climb up again for whatever reason. Maybe the bond market says the economy is way weaker than everyone expects. Interest rates have got to change again, or whatever the scenario is. The bond market is now, and it could be just retracing an uptrend. Very simply, we had a pretty sharp move up, and it's certainly due for some counter trend move as well. So just wanted to talk a little bit more about the logic of momentum style stock trading. And we're focused still on the idea that these are companies. Okay, these are stocks that are moving higher. CLOV was a new trade we added into today. It's up 9%. So far, so good. Okay, and that's what do we know about this company? Not a whole lot at this point, other than it's in an uptrend, it's moving higher, it's in momentum. We can establish our risk profile. Where does my stop loss need to be if it does move lower? And then as it's trending higher, we're scaling out of those trades by selling certain percentages of that stock as it's moving higher, and trailing a stop on the rest of those shares as we're moving higher as well. Okay, and that really is what we're focused on. Now the fun thing is to get even deeper and say, man, this is really moving. What's going on with these guys? And I've mentioned this before. You can, if you want to go out and just go out to their website. I like to go to that Google page and then go out to their website here. This might have even been one we looked at last week. Okay, so these guys are doing Medicare health plans. Okay. Medicare plans. Interesting, very interesting. So maybe if I am interested in that, as far as what they do and why they're doing it, and a little bit more about the company, a little bit more about their financials, I can spend some time going over that. But my first and foremost goal is, why is it moving higher? Why is it that, or that it is moving higher? Institutions, big money is pushing this higher. I don't have to know exactly why. I just have to know that that's the fact. It's moving higher, and somebody with a lot of money thinks that this is worth buying into. Okay, it's $1 billion market cap. The average volume is 26 million shares. Okay, it's attracting big time money, and that's and everything else is secondary from there. I don't want to have to comb through the balance sheets and figure out I can see that their EBITDA is this, and their management's doing this, and this is doing that. And fundamentals tell a story, and that's why we include them here in terms of the annual EPS. Annual EPS is up 116%. Last quarter EPS, earnings per share, so the earnings of the company is up 120% from one quarter to the next. So they're growing really fast. I should say they're making money really fast. That's the most important part of a company. Are they profitable? Are their earnings per share growing? And if so, how fast? That's the fuel that a company needs, or proof that the stock should go higher. The value of the company as a whole is going higher. The stock price is the representation of the value of that company that we can all buy into, and then we have opportunities to buy into amazing companies that are doing amazing things, and we can all participate in those moves. Now, granted, because it's an auction, people are buying and selling, and you get overshoots to the upside, overshoots to the downside, and those can cost us money if we do the wrong thing at the wrong time, or have too big of a position at the wrong time, or have too big of a position entirely, and then we can, and something happens and this thing just reverses. We didn't know the information. New information comes out, and all of a sudden that new information spanks us back to reality. Okay, that happens. That can happen, and the only way to manage that is with position size and stop loss as well. So keep those things in mind as you're determining your own trading plan, what it means for you in percentage of your allocation, what percentage are you invested in the stock market right now. I'm about 20%, okay, not quite 25%, and relatively small positions. And we've had a lot of volatility. We've got a couple of winners. We're getting stopped out of some stuff. We're having some losers. We're typically going to have more losers than winners, but our winners will typically hold on to those and let those just continue to work. As they keep working, they keep working, they keep working. We might get 3 that work really well and 7 that stop us out. Maybe 3 of those are for full losses. Half of those are for break even, some for small gains, some for small losses. Okay, we just have to average those out and continue to follow that overall methodology as we're looking for these kind of names as they're moving higher. I'm going to end on that note. I appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Bye now.